For more on the markets right now, we're joined by Savita Subramanian. She is the head of U.S. equity and quantitative strategy at BofA Securities. And Savita, this morning it seems like there's relief that the Trump administration seems to be ratcheting down, not just on what we're talking about with Jay Powell and allowing the chairman of the Fed to say, OK, he's going to independently operate,
right,
but also on how tough we're going to be with China in these trade talks.
Yeah, no, I think that every day is another soundbite, either positive or negative, that roils the market. I do think it's interesting that we seem to be in an environment where investors are just laser focused on one topic. So
what's that one topic?
And today,
because I can think of like four or five.
Yeah. Well, it seems to change every day, but and I don't know how we're going to end the day. But yesterday it was, is the Fed chairman independent?
Right. So is this the Fed? Is this the trade talks? What?
So it depends on what the tweet or the soundbite is, I think.
Yeah.
But I mean, I think that underneath the surface, what we're seeing is really a rotation from just tech and global growth plays to value, to dividends, to, other parts of the market really taking
Okay,
control.
that makes a lot of sense. Just this idea that we don't know where tariffs will end up. There will probably be some base level.
We're assuming a de-escalation from here.
Right.
And our target for the S&P is a bit higher. We took it down after Liberation Day because I think we were surprised by how kind of aggressive and high the tariffs were that started. I think, 5,600 is achievable by year end. That's our target on the S&P, which is a few percentage points away.
Yeah.
If anything, I think we could see an upside surprise because when I think about what's happening right now, it's all negative. It's tariffs, it's, immigration, it's inflationary, it's negative for growth. But going forward, what are we going to start hearing about? I think we're going to start hearing more about deregulation, some of the more positive themes for stocks, potentially tax cuts, et cetera. So I think there is like a runway here where we could see good news bolster the market.
And that leads us to earnings season. You're in the middle of it right now, and you're going to be hearing from companies.
Yes.
AT&T was out this morning and said, hey, it had a great first quarter and is now willing to stand by its guidance and that it doesn't think tariffs are going to be a huge issue for it.
There are some tariff-proof stocks in the S&P.
And that's what you're on the lookout for? And
that's what I love. I think they're really sort of old economy. Like AT&T is a perfect example. If you think about what we have to spend money on, we spend money on rent, on our energy and heating bills, we spend money on insurance, we spend money on. So that's basically financials, energy, telecom, which are all sitting there in the value bucket, paying nice dividends, and are relatively immune to a lot of the noise that we're hearing around, global turmoil.
Are there other companies that you would put in that basket? I'm just trying to think of who is uniquely positioned for not getting crushed.
Yeah, I think that multinationals can actually do a little bit better than what's priced in, because they have a lot more optionality than, let's say, the smaller companies that just supply to the big multinationals. So I think that's another opportunity to really look within these beaten down areas, even tech. Like if you think about communication services and some of these, new media companies, these are the new staples. These are the new utility stocks that we're probably going to continue to pay for and subscribe to going forward. So,
I mean, that's a really interesting point. Are you suggesting that people should not go into the Russell 2000 right now because small companies can't go and ask the administration for an exemption from any of these rules?
Exactly.
They have less flexibility with any of these issues. I mean, it seems unfair, really. It reminds me of when the big boxes were allowed to stay open during COVID, but the small stores
it's survival
and
of the
restaurants got
biggest.
crushed.
I think we're still in that environment because, again, just thinking about optionality around tariffs, if you're a big multinational and one region is, verboten, then you go to another region. You have options to kind of shift your supply chain. I think with the smaller companies, there's a lot of refinancing risk for these companies. So I think we really need the Fed to start cutting in order for the Russell 2000 to really work. Because
that's interesting.
These are companies that have a lot more rate risk. They're more credit sensitive, whereas larger companies have paid down their debt. They've become very immune to credit cycles, which is kind of interesting. I mean, I think today we're in an environment where stocks look pretty healthy, especially in the larger cohort. The real risk is in our Treasury bonds, because we've got a foreign buyers strike. We've got, you know, the folks that used to buy Treasury bonds, the Fed, China, Japan, no longer buying. You've got debt through the roof. I mean, this is the leverage risk basically shifted from consumers and corporates during the GFC, the global financial crisis, to the government. And I think that's the area where you could see continued.
Well, then,
pain.
if the Fed cuts rates, is that even going to help?
Well, that's the short end. I think that's, you know, it's going to help with companies that have floating rate debt, like in that smaller cap sector. But I think on the long end, we're in for higher long rates for the foreseeable future.
Because buyers are going to have to be enticed.
I don't know what gets folks to come back and buy a lot of Treasury bonds at this point. I mean, maybe it's solving our deficit problem, but, you know, beyond that, I wonder if they still have that high quality safe haven status that, you know, we used to, you know, paint them with.
Well, who else are you going to buy?
I mean,
Who's safer?
You've got.
I mean, you're talking about 30 basis points. You're saying that there's a buyer strike when we're at 440. You're ready to slit your wrist. We were at 7 and 8% for my entire career.
Yeah, exactly. But I think that's kind of where we go back to. I'm not.
What, 7 or 8%?
Well, I mean, it's higher than 440. I think 440 might be too low.
Well, if we get a slowdown from a tariff-related slowdown, we're probably going down in yields.
Well, I don't know if we get the slowdown. I mean, if you think about what companies have been saying during earnings season, it's not we're canceling everything.
What about all the uncertainty?
You know, the uncertainty is there, but I don't know if it's actually meaningfully changing behavior yet.
Well, that would be good then, wouldn't it?
It would be good. But I think that's the reason to look for stocks that have really no limited exposure to tariff risk or can navigate tariff risk, that have been sold off summarily on just the headlines of, you know, global trade war. I think what's interesting, though, is that, you know, we're sitting there listening to every company. We're scraping the transcripts, looking for evidence of major project cancellations, delays, you know.
Right.
And we're not really hearing it yet. I think the longer this goes on, the longer this uncertainty, you know, extends. And, you know, if we start to hear the numbers going higher and higher, that would be bad. But where we are today, we haven't really seen it meaningfully hit business activity.
Liberation Day was April 2nd.
Yep. It's not that long ago, so maybe
23rd, is it?
Yeah, I mean, it's a few weeks, you're right.
The 23rd.
But I think that's what we need to listen for, and so far, so good.